Hello everyone, welcome to this lesson on bullish mitigation block. The last time we talked about bearish mitigation block, which is we look for bearish mitigation block and the highs when the highs are not when the highs make and there is a failure swing. Now for bullish mitigation block, we look for a discount of that price range. Discount of the price range that we are dealing with. Maybe it's the new leg of the price range, or maybe it's from the older leg. But of course, we all know that the price is fractal. So what you see in the higher time frame usually replicates itself in the lower time frame. The good part of it is that if you have a higher time frame in sight, it validates what your lower time frame is doing. So let's get into it. Bullish mitigation block is a specific price action pattern that signals a potential reversal from downtrend to an uptrend. It forms when a downward price swing fails to create any lower low and is then followed by a strong upward move that breaks the previous lower high. The identification, let's get to this tool here. The price has initially been making lower low, lower low, lower low. Now, when the price gets here, just like it did before, it's expected that it makes a new lower low. But no, instead, it fails to swing, fails to take out that low. That means it's a failure swing. That's why it's called a failure swing. Then the next moment, there's an impulsive move higher. If there's an impulsive move higher, that's where savvy traders come in and look at the seeking. There is a failure swing and it's happening at the discount range of the PDRA. It's important that you master your PDRAs. Once a failure swing has formed at the discount rate, what you mark out is look for this low that has failed to meet that lower low. You run it, whether it's an hourly on daily on 15 minutes. Your back testing will tell you what time frame you work with. But now, if it fails to make that lower low, and instead it runs an impulsive move high, you wait for price to get back here. This is where you look for your setup. The first signal is fail to establish the lower low, or for it to make an impulsive move upward, and then you wait for it to retest that level that failed to make the lower low. If you retest and print your setup, that's where you go longs. Just like this identification that I mentioned there, you establish a downtrend, then a failed lower low, then you break a market structure, which is this impulsive move. It fails, then makes an impulsive move upward. And that's your mitigation block. You see, mitigation is this price coming back here to take liquidity here. And then off it goes. When it prints the setup, always look out for once this price, if there is a grab, a sweep or stop hunt, sweep of liquidity here, it makes the setup to be a higher probability setup. You can even get A++ setup. The important thing is once you can identify it, that's where you call all your discipline mindset into action. You always look out for a fair value gap around here. A fair value gap always invalidates this setup. Say you find an FVG when this impulsive move run up through this bearish block that failed to make a new lower low. Now, the simple steps: identification, patience for the price to come back to this level. Then already it's okay to take your stop loss. Be try below this low, your stop loss should be low. And then this, of course, you know that this is for educational purpose only. Your risk appetite depends on you as a trader, but the basic advice they say 1 to 2% of your account. it's not dependent on when you find an A plus plus setup that you've already back tested and it gives you a very high win rate, maybe 80% win rate, then you can decide to give your risk appetite a boost. This is not my advice. I'm not a financial advisor. This, but this, what the basic thing I'm trying to tell you is what the questioner proposed only. This is in a bullish mitigation block. You wait for this price to retest this level. If you have a fair value gap around the after that, possibly that increased probability. That's increased probability for you. Then let's move into the chart now and see what I marked out here. Of course, this is gold USD, and gold has been bullish of late because of their. But normally, this is not tendency for US dollar. When it gets to the fourth quarter, it tends to go down, But then recently, most interaction with USD has been bullish. It has been bullish for a while now. Here on the hourly chart, let's look at what happened. See, the price was initially bullish from this place. Was initially bullish, and then on Thursday, that's 2nd of October, it took out the high of New Year's Eve. Then it became a downtrend, and of course, it began about a downtrend. Was when it made this relative equal highs here. This is a relative equal high. Relative equal highs usually attract price back to it, but then it sold off. And this a low. Then there is this little progression, but there's an hourly chart. So we'll see when we go into the lower time frame. We'll see what happened there. It makes a high, and then you see it's supposed to another low here. It's supposed to always looking at it. Maybe it's going to start rolling off. Whereas from history, you see, once you make a double top, that means price reversal is going to happen. But we are not want to pick tops and bottom. What we're here to see how the market reacts with the global news. Once the news is out, how the market reacts with it, how gold prices reacts with the USD. That's just how the reaction is. When the reaction is one, you're not the one to decide what the news is, but once the reaction of the news trends on the technical analysis, as well, that's why your back testing always gives you higher confidence because you say this reaction over and over, and this what happened. If the market makes failure, then there's a failure swing, and then you see off it goes. This is the price point I wanted to look at, but we'll get to it. Off it goes. There's no return back for you on the hourly. We let me look at what happened at this price point. Let's remove this and go to the lower time frame. So once I saw this price movement on Thursday, and I noticed that the price moved up. There is a fair value gap. There is a breakaway gap here. There is a fair value gap. And this fair value gap now, let's say this fair value gap, once it has been tapped into, I was looking forward that, okay, this hourly fair value gap was supposed to drive price lower, which is making a lower low. But it didn't. Instead, the price swing stops here. That is making a failed swing, just like we say, a failed swing, failed lower low. Once it had made a failed lower low, and price started ramping up. Okay, this is what I'm supposed to look at. And marked out this block on the hourly chart. Then I marked out this series of down close candle on the hourly chart as well. And let's go into it and see what happened there on the 15 minutes time frame. See, market opens up. After that failed swing low, market moves up. And then this is the first hourly. This is the first hourly. This is the first hourly candle that I marked out before this series of down close candle. This is the first down close candle that I marked out. Look at what happened here. You find out the market opens up. Market never really crossed below this candle. It never closed below this candle. It kept tapping also that series of down close candle, you never really close below this candle. And then we are looking out for, see, next moment, market takes off from here. Now, we can like this now. This is the 15 minute. Let's look at what happened in the 1 minute time frame. We are assumed to have deleted the first rectangle that I drew here. Um, Then here on the 1 minute time frame, let's see what happens. This is what I wanted to show you. Now, the market opens up. This within this, this is a sensation from this, and from when the Asian market opens. Around 18 down to 2:30. 2 o'clock is the official time, but 2:30 something actually happens around 2:30 that make the that's the first manipulation. That's actually what happened there. And the first manipulation that happens around the charts from my own back testing. You can do yours and maybe you find a different one works better for you. But the first manipulation in the market, there is something that happens around 2:30 Eastern time. There's New York time. Around 2:30 here. With first 2:30. Look at what happened at least this 2:30. There is something that happened around 2:30, but I think that will be the topic for that day. And then you see the markets moving around. Then all for it to take a sweep of liquidity when it was long session opened. And long session opened, now that sweep of liquidity is taking, you see the market creates another lower low. Like not lower low, it creates a lower low line one that sweeps out that London session. It sweeps out this from this place, this green amount of we have better illustrate this on another lecture, but I didn't mark out all this. I'm just trying to see if I can put in more, tell you more in this one. Then this market takes a lower once London session or once New York session, it takes a lower low. And what happened? Another let me remove this one now. I think I've gotten what I need from here. You see another failure swing for me here. And after the failure swing, after this failure swing happened in that New York session, market took off immediately. That's why marking it out on the higher time frame works better. Now you really have the higher time frame idea on your head, then or on your chart already, you really mark it out. Then on the lower time frame, the 1 minute, look at it. It never really fell down into those series of bullish hourly candle here. From here, it takes off. And that's how the price delivered on Friday. Though there was no rush, but these actually affected stocks, but gold seemed to move. Gold mean it's moved higher. So out of here, out of this high, you could have gotten an entry. Then here, great soup of liquidity is an entry for traders to take their profit. So with this, we'll come to an end of this. Your back testing is what will help better. Which without a back testing, whatever I say, treatments, everything, without back testing, we are still within the mediocre trader. It's better at backtesting. Continuous learning and backtesting. Financial markets are dynamic. Continuous study preparation, backtesting strategies. Refine understanding of bullish distribution block and adapt to changing market conditions. That's just what backtesting is. It grows your confidence as a trader. You understand the mitigation block, the how it forms, how the mitigation block forms. You see how to take entry. The next thing is just to backtest it over and over and be more conversant with it. That whenever the market makes an impulsive move, you map out your charts. You sweep off liquidity, you map out your chart, and then look out for what happens next. You're not the one to pick tops and bottom. You just get to look at how the market reacts with the global news, and then take your trade and be profitable. Remember, risk management is a strong arsenal in every trader's a strong tool in every trader's arsenal. Happy trading, guys. We'll see you next time. Thank you.